A lot of people believe in just picking stocks or mutual funds. Why is asset allocation needed?
True, but how many of us put our entire investable surplus in equities or mutual funds? I think very few, if any. Many of us put our entire investable surplus in a fixed deposit or in some fixed income fund. Most of us manage our investments in equity and our savings as two different portfolios. So whether we like it or not, we are always taking some asset allocation decision. But we do it suboptimally. We either leave too much on the table, where someone else is making money out of your savings, or take too much risk which we should avoid. But when you take your asset allocation decision based on your needs and your risk profile, you take better decisions. Let me explain to you by taking two important asset classes, equity and debt. So why do we need to invest in both these asset classes? As you know, our long-term goals fall into two buckets, security and growth, and we must plan to meet both of them. However, many items in our security bucket are a must, and we have to meet them when the time comes. We cannot say, let's postpone this because the equity market is down and it is not a good time to sell our equity holding. In short, the markets can be at any level when we need the money, even the ones that we have planned for. Having both equity and debt in our portfolio allows us to handle this much better than when we have 100% equity in our portfolio. There is one more reason to do asset allocation to debt and equity, and that is our ability to handle a drop or a fall, even on paper. This is what is called as a drawdown. And remember, there is always noise in the media that amplifies things, scaring even the best of us. With a large portion in equity, we run the risk of higher drawdowns. When that happens, retail investors can't take the loss and exit the market. Even the so-called aggressive risk profile investors, when they have 100% of their investable surplus in equity, panic. So we need a mix of debt and equity. For example, if we have a 50-50% allocation to debt and equity, a 20% fall in the equity market will mean only a 10% fall in our net worth, something that most of us will be able to handle and stay invested. And if you are managing under smart asset allocation, you could actually buy more equities because they are available cheap. So I would tell every investor to first do their risk profiling and then smart asset allocation.